Today's topic, acronyms and terms that relate to property and mortgages. Hi, I'm Jeff Banks, the founder of Banks Consultancy.
And I'm Robin Banks, the CEO of Banks Consultancy.
And these are our tidbits of the day. And today we're going to talk about 3 terms that you might come across if you're buying a home. Now, Robin, what would you like to know about today?
Let's start with LVR.
Okay, LVR, or the loan to valuation ratio. This ratio determines the amount of money that you've borrowed against the value of your home. Now, normally it's against the purchase price of the home, but sometimes the banks will use a valuer who'll come in with a value less than the actual amount that you're going to buy it for. So if the valuation of the house is $1 million and you're borrowing $800,000, then your LVR is 80%. LVR is an interesting term because a lot of the lenders use that ratio to determine whether you need mortgage insurance or anything like that. Okay, now what's the next one you want?
That was very helpful. I now understand that a bit better. What's DSR then?
A DSR is the debt service ratio, not the debt to service ratio, and it's a ratio that the bank used to determine whether you can afford your loan. Now, we talked about LVR before, which was the amount of the value of the mortgage versus the value of the home. This one determines whether your income, and if you're an investment property, possibly the rent included, will actually service the loan in the event that the rent stops, or if in the event of a first home buyer, you can just afford to pay the loan.
Okay.
Now, you understand that one?
Yeah, that's a little bit better too. And now the next one I've got is a bit of a tongue twister or a tongue tire. Cross-collateralisation. Okay,
cross-collateralisation. This happens where a person who has a home might very well look to buy an investment property, and the bank will say, okay, if you're going to borrow 100% of the value of the investment property, we're going to want more security, and what they'll do is cross-collateralise the whole loan over all of your properties. Now, if you can help it, you shouldn't allow this sort of thing to happen. You should set up 2 separate loans, one on your home for the excess that you need, and one on the investment property, so that there isn't this cross-collateralisation. Because if you have an investment that is cross-collateralised with something else, should you sell it, then you've got to refinance everything, including your original home loan. So it actually works out better. If you can set up separate cells of the loans that you need across the properties that they are needed to do, it doesn't matter that your home has a loan on it for an investment property. If the intention of that money was to buy the investment property, the interest will still be deductible. Now, that's one of the things that we have to be very careful with in an investment sense, is to make sure that you don't pollute the intention of borrowings with tax deductibility. All clear today?
That sounds a lot. It sounds something that we should look at and make sure we don't end up in that situation.
Exactly right. If you want to run your mortgage past anybody, come and talk to us at Banks Consultancy and we'll help you with what you are. Okay, that's enough for today. I'm Jeff Banks.
And I'm Robin Banks.
And we are Banks Consultancy, not your ordinary accountant.